Well, the penultimate day to the budget for Indian markets, and you've seen actually not a bad market, you have to say. A very flattish move for the Nifty. Some resurgence of PSUs. I mean, the top gainer on the 500 is a fertilizer company, and that tells you a story or two. But a lot of other PSUs too have come back. So a bit of a surge for PSUs, and look at that, the Nifty PSE up 1.81%. And the mid-cap and small-cap indices will come up on your screen, because while large caps are being put under pressure by Reliance and Kotak, small caps have had a very strong pullback. Just the intraday of the Nifty mid-cap and the small-cap indices will show you that the indices started off weak and looked wobbly, but I think the pullback has been very, very strong. We'll just go to the heat map with a bit of an intraday check. Look at this. When it started off, we hit the day's low almost immediately, and then it's been a great day of recovery with trading almost close to the day's highs. So not bad going. The market breadth would be positive. Get the heat map up on the screen. And before I toss to Tamanna, just mark the large caps and what they are doing in the session today. A bit of a turnaround in that while the set of losers is still the same, Reliance has lost a bit more, Kotak has lost a bit more than the morning, and Wipro is still down 9%. ITC too, interestingly, is corrected. But the quantum of green has gone up from just about 8 stocks in the green to more stocks in the green than red, and enough number of economy-facing names, Grasim, Ultratech, M&M, HDFC Bank coming back. I think that's the story of this afternoon, Tamanna. A very strong surge, particularly for PSUs, but good mood because we are flat as opposed to being substantially lower.
Absolutely, and HDFC Bank has been the star, I would say, because the way it was being completely drubbed before markets opened on the back of its numbers has seen a big surge over there. Definitely, Niraj, I would agree that not half bad. And the rebound really is the story. So I just want to pull up the advanced decline ratio for the day and just give you a sense of how that has also narrowed. So you started absolutely negative. The start was actually a bit dismal, about 100 points down on the Nifty itself. But as you progress through the day, you have seen some strength coming in, and that sort of continues. So not bad at all to advance to decline ratios at this point. 1309 to 798. I just want to pull up what the broader markets are doing before we get to specific stocks that are in focus today. And the real recovery has been here. Look at the Nifty Mid-Cap 100. Niraj spoke about it. We'll pull up the small cap index as well and see what's happening there. Just about 1% up. Let me quickly pull up sectoral indices before we move further. And yes, PSEs are the big winner. But you're also seeing a bit of budget play coming in that sense. Pharma, auto, all of these are doing fairly well. Realty has been the big loser today, and Phoenix Mills on top of that chart. I'll talk about it in a bit. IT and energy also hurting. All right, let's get specific on stocks that are moving, that are buzzing today, and I'm really going to start off with the fertilizer packs. Whether it's an RCF, whether it's a fact, you have fertilizers completely in action ahead of the budget. Remember, the widely held belief and expectation is that the budget is going to focus on rural consumption, moving up the agricultural sector, and fertilizer subsidies could see some impact over there, which is why you're seeing fertilizer stocks in action today. Let's look at Indian Hotels. Indian Hotels is the other big surprise move. The Q1 numbers were okay, honestly. The revenue slightly lower than expected. It is a seasonally weak quarter, but elections, heat wave, the fact that there were no wedding dates, crucial wedding dates in that quarter have impacted. Management commentary is very positive. We spoke to Puneet Chatwal today. We'll play out a clip of that conversation as well. But it's the brokerages who have been quite constructive, and which is why you're seeing Indian Hotels up about 8% today. Oberoi Realty is the other one. It's the outlier because while you have, say, a Phoenix Mills completely down and out, Oberoi Realty on the back of its strong Q1 numbers has seen an up move today, which has stayed steady through most of the day, one must say. Budget focus is also back. Remember, now these are the buckets of stocks which were really not doing well at all for the last few sessions. But today you have an HAL, a BHEL, an REC, for example, all back in action. Mid-cap IT is also doing fairly okay, while a Wipro is the outlier, I would say, just 9% down and completely continuing to be drubbed. Mid-cap IT is fine. Persistent L&T Tech emphasis, not half bad over there. And just we'll round off with Phoenix Mills, since I've been talking about it. That stock under massive pressure. No clear reason visible fundamentally as of today, here and now. Maybe a bit of profit booking, taking it off the table, but 7.5% down on Phoenix Mills in this afternoon's trade. So, Niraj, one reckons that some of pre-budget action can't be ruled out in those specific sectors. And remember, we've had a lot of people coming and telling us that these have already run up, stay away. The markets seem to have something else in their mind.
Yeah, the market seems to be actually following maybe what managements are saying, because I think, as Tamanna said, and as you will hear from the Indian Hotels management on this show as well, their commentary seems to be dragging the stocks or taking the stocks higher, as opposed to what the market belief on the valuations might be for some of those stocks. I was effectively referring to Indian Hotels, but I think that's true for a clutch of other stocks as well. Aditya Agarwala of Invest for EDU on the technicals, Vijay Chopra of Enoch Ventures on the fundamentals and technicals, both join us on the show. Gentlemen, both of you, thanks so much for taking the time out. Aditya, a day of resilience, you would have to say, but and more so, a day of a bounce for the PSUs, because ahead of the budget, a day before the budget, not too many people would have anticipated, but PSUs have come back very, very strongly today.
Absolutely right, Niraj. Good afternoon to you and Tamanna, and thanks for having the show. It's quite a bounce back, especially in the broader markets, I would say, because that is one space where we had seen the sharp sell-off last week. And from there to see this kind of a recovery is actually amazing. And then says that markets are down but not out, and every dip is bought into, maybe a couple of days of decline, and then markets quickly get bought into. I wouldn't be surprised if from here on we see a rally in the Nifty as well. Maybe towards the end of the trading session, we might just see Nifty scaling closer to about 24,600, 700 on the upside. On the downside, clearly 24,400, 24,450 is acting as a very good support area, and looks like it's heading towards that 600, 700 mark on the Nifty. The Bank Nifty too is looking like there could be a short covering rally in the Bank Nifty as well, just before the budget. Maybe in last hour of trade, you can see a bit of short covering rally in the Nifty and the Bank Nifty, both as broader markets are holding on to its gains quite steadily from the start of the show.
So what, Aditya, in light of that then, what are the stocks that you're recommending just a day ahead of the budget for a trade?
So I've got a couple of buy recommendations, Niraj, and both you can say could be a proxy play to the budget, because chemicals is something which is buzzing around in trade, and specialty chemical is something which is looking very good. PI Industries is something that I've picked up for our viewers today, and stock seems to have broken out from a sideways consolidation phase on very good volumes. So I think stock is poised to test levels of 4,500 to about 4,600 on the upside, with a support on the downside at 3,750, 3,800. That should be a stop loss. And it's a buy recommendation for a target of 4,500. The second one is Wellspun Living. Very interesting name here, because this is one stock which had entered into a long consolidation phase after it made a high in November 2023. And from there, suddenly we are seeing a good run up in the stock on volumes. The stock has broken up from that consolidation range. And in trade today as well, we see an up move on very good volumes.
Aditya, we'll have to cut it because Anant Nageshwaran is giving an address on the economic survey.
Good afternoon, everybody, and thank you for being here. Just a personal declaration. We didn't organize the rain to make it difficult for you to come here, so but we welcome it, like all of you would, given the temperature we have been facing for the last several weeks. And thank you for being here. This morning, Mint very helpfully reminded me of what I wrote in the interim economic review in January. I had spoken about global factors, the introduction of artificial intelligence, the need to balance energy security and energy transition, and of course the imperatives of employment and skilling. Now this economic survey actually picks up on those themes. And more importantly, it tries to identify the areas and actions that we need to take such that these four important challenges can be addressed as best as possible. In some sense, this survey picks up on the theme that all hands on the table must be there, And no economic approach will be exclusionary or will be excluded. We need manufacturing, we need services, we need agriculture, we need the public and private sectors to act together. We need union and state governments to act together. Because given the way the global conditions are evolving, we don't have the luxury of picking and choosing specific approaches in our path towards Viksit Bharat. And that is the overall theme of the survey itself. First, the global outlook. You can see on the charts here that both merchandise trade volume and industrial production growth have steadily come down in terms of the averages over the last 20 years or so. Somewhere between 5 and 10%, they have come down to between 0 and 5, and now they are struggling to even stay above the zero line. So in general, global growth and global trade volume growth will be difficult to come by. And therefore, the way we can grow our exports will not be because the trade pie is growing, but because we have to grab market share in terms of competitiveness and quality, etc. And second factor, there is global protectionism and a sense of nationalism just in time giving way to the idea of just in case. Security dominates efficiency. Supply security dominates supply efficiencies. And you can see that in the last 3-4 years, protective actions have actually moved up very, very sharply, trade protective actions. And the reasons cited are on the right side: competitiveness, climate change mitigation, national security, geopolitical compulsions, concerns, etc. But this is going to be with us for quite some time. So we need to be mindful of that. And then the climate challenge and geopolitical fragmentation. We will be speaking more about the climate challenge later on in the presentation. It is about balancing, as I have written also many times in the last 2 years, it's about balancing economic development and also energy transition. But let's remember, historically, energy transitions have not happened in a single generation. Václav Smil has written a lot about it, and especially with so many countries going at it together. I can have it here. Especially with several countries attempting net zero at the same time and trying to achieve energy transition, it is going to be a major issue in terms of resource availability, etc., etc. And then when it comes to geopolitical fragmentation, we are seeing it every other day as well. And this chart on the right shows you how much the mention of geopolitical fragmentation is happening in corporate earnings releases and announcements and so on and so forth. From a bipolar to unipolar to multipolar world and different blocks emerging, etc. It is something that will be with us for some time. So these are the 4 headwinds that did not, for example, affect East Asia. Japan, East Asia, or China, when they were making their transition from lower income to higher income countries, they didn't have to face these headwinds. From 1979 to 2015, China, for example, did not have to worry so much about geopolitical fragmentation, climate challenge, and global trade. Globalization was at its peak. So we have to now chart our path to Viksit Bharat amidst these headwinds.
So that's most likely going to be the big theme for tomorrow's budget, the path to Viksit Bharat. Now that's very broad-based, it's long-term, it's going to happen in 2047, that's when the end goal is. But the fact is that policies to move towards that end goal could be announced and will start implementation much earlier. That's what stocks will react to, that's what the markets will react to. So we need to put that into perspective. Vijay Chopra joining us from Enoch Ventures. Vijay, very good afternoon. Great to speak with you today. You know, even as we talk about a lot of these companies, government-run companies, PSUs, those that are going to benefit from larger capex spends, we're saying that they've run up a fair bit. Are there any of these pockets or segments, specific stocks that you would look at positively ahead of the budget?
Well, there's hardly any time in the budget. You know, we have just about 45 minutes left for the market, and then tomorrow morning we have the budget. So I don't see a reason why to jump and buy right now. Why do we are so hell-bent upon, playing the budget? It's not a game after all. And I would say that better wait for the budget to give us a guideline way to invest. But all said and done, I think that infra would be one space I would be looking at, and definitely the allied sectors like steel and cement. So these three sectors look very good to me. Defense, definitely, I'm sure that there's going to be a budget outlay there, and post the budget, we would really try and understand, what kind of budget has been allocated, how much R&D is going to happen, and how these companies are going to be benefited. Fertilizer stocks are buzzing. We really don't know what the finance minister is going to say about the fertilizer stocks. Last time it was about the GST reduction, but it didn't happen. So again, it's very difficult to speculate. Being a person who has seen maybe, in my entire career, more than 25, 30 budgets, and I've been watching since almost I was a kid. So I think that there's no point of speculation. Let's hold our horses, wait for the finance minister to roll out the plan. And the market is not ending tomorrow. And I would recommend very, very strongly, no need to just jump and buy tomorrow. As soon as the budget ends, people start buying. Just wait, just chew upon it and, go through the fine print, because there's a lot of fine print in the budget. I've seen many, many times, the market doesn't show any reaction on the budget day. But the next day onwards, once they actually understand what's in the fine print, and mind you, the devil is in the fine print.
Correct.
So we have to very closely watch it and then take decisions.
So you're sitting on the sidelines tomorrow, Vijay?
Precisely.
And watching NDTV profit?
Hopefully, yes.
Hopefully, yes. All right. Okay, I kind of arm twisted you on that, so I'll let it go. But all right, so stay on the sidelines, says Vijay Chopra. But nevertheless, you talked about manufacturing. And one of the key incentives for the manufacturing policy is production-linked incentive schemes. Now, we had a conversation today with a company that has truly benefited, could be the poster child really of how a PLI scheme actually works to change things. So Saurabh Gupta, CFO of Dixon Technologies, spoke to us today about his expectations from the budget. Listen in.
One thing which we really expect is that if you look at the whole domestic manufacturing for electronics, where there has been a lot of policy initiatives and the government policy framework has been very, very supportive. So the first level of domestic manufacturing ecosystem has been robustly built in India. But if the India needs to go to the next level, then it has to increase the level of the domestic value addition, which can only happen through incentivization of the component ecosystem. So we expect that the government should announce something on the creation of a component ecosystem, especially on critical components which go into the mobile phones, because presently the mobile phone, the valuation is presently hovering between 15 to 18%, with some kind of incentivization for components like for mechanicals, display assemblies, camera modules, battery packs, chargers, and vibrators and all, which are critical components of mobile phone. Clearly, that level of value addition can go to almost 38 odd %. So that is something which we really expect, and there have been a lot of media articles to that effect lately. Secondly, in the interim budget, there was no talk about keeping that rebated income tax of 15%, which was earlier announced. So we would hope that 15% tax for manufacturing companies comes back. That will really bring down the operational cost and also encourage more investments in the sector. Third, we feel that the peak rate of taxes on some of the inputs and the key raw materials, especially on the sub-assemblies, should come down from 20 to 15%. Then there should be further reduction of that duty on input parts from 2.5% to 0%, because that will only, one, align India with the global value chains. And also it will bring us in line with what the simplified duty structures are in China and in Vietnam. So these are the three things that I would really hope the government should come about. And of course, in addition to that, the budget provisions can be towards allocating more infrastructure like industrial parks for electronic manufacturing clusters for promoting electronic manufacturing, something on R&D to create more innovation, to encourage more innovation in the electronic sector. and also some skill development programs to enhance that whole overall talent pool in the electronics sector, which is aimed at improving the productivity and overall skill set of the employees. So this is something that we expect and we would want the government to really think about.
Well, that's the big voice, as Tamanna said, the poster child of this whole PLI or the EMS field. But one more set of numbers that came out earlier, or rather yesterday, was Supreme Petrochem. The numbers look good on the face of it. Revenues up 28%, operating margins expand, and PAT up 76% at 122 versus 69. The stock took an initial beating because the numbers were below what was estimated, but has recovered a bit because it was still a strong quarter. Mr. Rakesh Nayyar, who is the ED of Supreme Petrochem, joins us right now on the show to talk about the numbers and the outlook ahead. Mr. Nayyar, good having you. Thanks for joining in. Decent quarter. What led to the kind of expansion, about 280 basis points, that we've seen on the operational metrics?
See, one, there's a volume growth. Overall, our total volumes went up by 20%. And last year in the corresponding quarter, if you look at it, we had then also mentioned that there was actually a dip, sudden dip in the styrene prices, which brought down the prices of the end product, and also it had put some pressure on the margins. But then otherwise, this particular quarter has done better than the last year, mainly because of the increased volumes and better demand from the OEM sector as well as the non-OEM sector. Both sectors have done well in this quarter.
So, Mr. Nayyar, this uptick in volumes, is this, I mean, one, what is the business case for this? And two, how sustainable or predictable is this for the remainder of the year?
See, generally the first quarter, that is the last quarter, or the first quarter of the calendar year and the second quarter of the calendar year, they are the good demand months. Then when the monsoons start, then they become the lean months, and post the festival season, again, there is generally a lean demand of the OEMs and the other products. So automatically the demand for our product also reduces there. So the first quarter, that is the first quarter of the calendar year and the second quarter of the calendar year, the volumes have done well. And going forward for the year as a whole, the guidance what we gave last time also was that our volumes would grow between 8 to 10% in the current financial year.
Okay. So that volume growth, Mr. Nayyar, what's the, how do I say, what's the difference that they will make for either the EBITDA numbers, or, for example, what could happen on the bottom line? Because as I look at your numbers, standalone basis at least, this must be probably the second best quarter in the last 8 quarters. It is, as you said, a factor of the volume growing as well. Will we see Q3 showing a substantial dip in both volumes and thereby on the EBITDA? And will it recover enough in quarter 4, or will it still be lower than what you've done in quarter 2?
See, it varies from quarter to quarter. And so the third quarter, that is the second quarter of the financial year, is generally the lean month. So it's very difficult to predict that how the OEMs behave in this quarter. And depending upon their sale, depending upon the non-OEM sale, the volumes will either increase or decrease. But then the overall in the year, we know that we will be able to increase our volumes by around 10%.
Okay. Okay, fair call. In which case, let me try and figure out what could happen YOY, sir. I mean, from FY22, if I'm not wrong, your numbers are circa 5,500 crores on the top line. And correct me if I'm wrong here. When does this change? Is there a capacity coming on stream? Are you thinking of any other inorganic moves, if you will? What happens for the, let's say, not just the next 9 months, but maybe the next 18 months?
See, the top line is a function of our raw material cost also. During the year 23-24, financial year 23-24, the raw material prices were down by almost 11% as compared to the year 22-23. Though our volumes grew in the year 23-24, but then the top line did not grow because the volumes were down by almost, the raw material price was almost down by 11%. whereas our volumes did grow by 13% odd, but then the raw material prices were down, so end product prices were down. So that is the reason that the top line, you may not see any increase or a substantial increase there, but then the volume growth is there.
Okay, and are you saying that that's how it's going to remain? You reckon that is the kind of number that you will probably deliver even in FY25 between 5,000 5,500 crores?
No, the raw material prices have marginally gone up, and with the volume increase, if the volume increases and the raw material prices are stable, to the extent of the volume increase, the top line will go up. If the raw material prices are dropping down, so automatically, as I said, the top line is a function of raw material price.
Okay, fair call. Is there a formal guidance that you're laying out, Mr. Nair?
I'll lay down a formal guidance as far as the raw material, our volumes are concerned, and which I earlier said would be between 8 to 10% increase during the year.
For the volume, not necessarily otherwise. The reason, before I wrap up, the reason I was insisting upon this is because when I read a few notes, Mr. Nair, they talk about how your EBITDA margins could actually expand in FY25 and 26 from about 9% to about 10% and 11%, and subsequently, their estimates of what your profit numbers could do are fairly high. I was just trying to think if these are outlandish estimates or could these be realistic, because from 346 crores in FY24, the notes presume that you might actually reach a number of 626 crores in FY26.
See, I don't know those estimates, but then we would be completing our mass ABS plant project by the end of this financial year. And also second phase of our EPS expansion would be over by this year. And going forward, they would be adding to our top line as well as our bottom line.
Okay, on ABS, demand expected to go up to 4 lakh MT, you have a capacity coming in. So I guess that's why the numbers of maybe 600 crores bottom line by FY26. You are saying these are not outlandish. I'm not asking you for a specific number, but these are not outlandish.
See, I really can't comment upon the numbers.
Okay.
But then yes, if I on the current prices of ABS at 100% capacity utilization, our phase one of our mass ABS, it will add 1,000 crores, about 1,000 crores to our top line. Similarly, EPS phase two at 100% utilization at current prices would add about 350 odd crores to our top line. So the top line will be a function of volume growth as well as considering that the raw material prices are stable.
Okay. Well, but we wish you all the best for that, because if you're adding about 1,000 crores on a top line of nearly 5,000 crores, that's a significant uptake out there too. So we wish you all the best for that and more. Thanks so much, Mr. Nair, for talking to us.
Thank you. Thank you.
Right. Just before we take that break, Vijay Chopra, do you track Supreme Petchem? It's recovered a bit of lost ground earlier in the day. And numbers that analysts are penciling in and what the management spoke about because of newer capacities coming on stream don't make it that expensive a stock, maybe trading at circa 20 times FY26.
Well, I suppose that the kind of progress the company has made, and I was just listening to the management, and Mr. Nair was quite positive and confident upon achieving those numbers. So it's a forward-looking management. I think the stock has done stupendously well. It is not expensive at all, and the kind of addition they are doing to the top line is really commendable. So I would say that wait for the budget. Again, I'm saying that just don't rush and buy stocks. Although I find that it is a good company to have in a portfolio, best around maybe 750 if you are able to get it in some corrections. 750 would be a very ripe level to get into the stock for the longer term. But yes, I'm happy with the way the management is confident upon achieving numbers in future.
Well, most managements do seem to be fairly optimistic, unless they're IT managements who are honest to a fault. The guidance sort of spokes the markets. Just another space, Aditya, I quickly want your take on before we get into a quick break, is on your energy space, your oil and gas. HPCL, BPCL, in any of those that you think are poised for better moves right now, budget or no budget?
They entered into consolidation phase, Tamanna, I would say. If we talk about the OMCs, particularly here, I don't see a major correction coming in any of these stocks, but I don't see an immediate up move as well. So maybe a post-consolidation stocks will see a run up again. If we talk about Hindustan Petroleum specifically, on the downside, 330, 320 is a good support area. On the upside, I think so stock can test levels of 390. Same holds true for IOC as well. Stock does look interesting. It's just that all these three stocks have entered into a consolidation phase. That's it, Tamanna. Otherwise, all three stocks look attractive on the chart setup. If you are looking at a positional trade, maybe for a quarter or so, then you can definitely add on to these stocks in your portfolio.
Okay, we'll take a very short break. On the other side, we come back with the F&O setup ahead of the big day, and we'll also talk a bit about one concurrent theme coming in from policymakers. It's in the economic survey. It's something that the SEBI chief also talked about later last week. It's concerns about derivative volumes. Does that hold clues for action that could be taken in or after the budget? We have that conversation when we come back.
back with India Market Close right here on NDTV Profit. Let's go across to Agam Vakil, who is standing by with the key derivative picture ahead of the budget day. Agam, I mean, what is the data looking like?
Well, it's very interesting, Niraj, but it does seem at the moment like the Nifty will face resistance at the mark of 25,000. And remember that particular mark isn't too far away from current market levels, because it just requires about 2.5% move on either side, and we actually could breach a psychological level. Of course, on the lower end, we're keeping an eye on 24,000, and on the higher end, keeping an eye on 25,000. It's not just a psychological level, it is also an important technical level, because this is where we have a significant amount of writing when it comes to the respective options. But, any trader worth their salt will tell you that to trade an event is also we're taking an extremely high risk, especially if you're actually going ahead and selling those options, which also means that if you in fact do see the Nifty breach any of these levels on the higher end or the lower end, you could potentially expect some of these positions to, move out the way, and because of that unwinding, it could further exacerbate that direction as far as the Nifty is concerned. But at the moment, we are still seeing a lot more resistance at the 25,000 mark as compared to the support at the 24,000 mark. Today, of course, was a day where it's turned out to be a flat movement. We are not seeing too much change in open interest. It's the same for the Bank Nifty. Again, we're keeping an eye on, the lifetime highs for the Bank Nifty, which is still a bit further away from current market levels on the higher end. Besides that, in terms of your overall levels, as I was mentioning, it is essentially 25,000 on the Nifty that we're keeping an eye on the higher end, and 24,500 on the lower end is where we are at the moment. But 24,000 will also be very, very critical. Besides that, in terms of stocks, again, today was a day where we had relatively quieter moves, but longs for something like Shriram Finance, Abbott and Alchem Laboratories, and among stocks which saw unwinding, we saw short covering for L&T Tech, Tata Chemicals, Gujarat Gas, PVR, Inox, as well as something like Ramco Cement. All in all, it was still a mixed day of trade, and I'd reckon a lot of traders will still wait to perhaps place aggressive bets before we have the outcome of the union budget, and not before that.
All right, so there will be a bit of wait and watch. I found that interesting, Agam, talking about 24,000 at one end and 25,000 at the other end being, the two levels that we could see. And of course, the big question, I think, Niraj, no one is really talking about it, but at the back of the mind, the big question for the market is that is there going to be some kind of punitive action to rein in volumes in derivatives markets? And the reason I'm saying that is all of the smoke signals which are coming from every end. And I'm not just talking about the SEBI chief saying very clearly that this has become now a macro issue. Look at what the economic survey said, and just the numbers. The number of unique tax IDs registered on the NSE has risen from 2.7 crores in FY19 to 9.2 crores in FY24. So you've had over a threefold increase. Most of the new retail investors are likely young and may have a higher risk appetite. It is also reflected in the interest that retail investors have shown in derivatives trading, especially expiration day trading. They're saying that they are mostly speculative instruments. The long and short of it is, they're saying that if people lose money in large quantities, they'll be cheesed off for a while and could feel cheated, quote unquote. That's actually there in the document. Now, they say this. SEBI chief comes and talks about how this has now become a macro issue. The question becomes that is there something in the offing that we could see either tomorrow or in a few weeks from then?
And safe to think that it is plausible, right, Tamanna? If it doesn't come, it's separate, but very likely because yes, said of the noise. And remember, this follows a report that came in sometime last calendar, wherein the SEBI said that 89% of derivative traders lose money, only 11% make money. So yes, there is certainly a serious think around the rising derivative volumes across parties, across regulators, and I would say across market participants as well. In fact, can we hear out Madhvipuri Butch, the SEBI chairperson, talking about this at an event organized by the SBI Mutual Fund?
If you see the volumes, the way that they have grown over the last 3 years, I don't think anyone could have anticipated that. If you see the number of young people who have entered that entire process and have lost tons of money, no one could have expected to see that. It has now reached a scale where we believe that the micro objective of protecting the individual investor has changed and morphed to thinking about the macro issue of saying, is this what our market is designed to do, to basically facilitate a lot of speculative transactions? Or at a macro level, are we worried that household savings are now going not into capital formation, but into speculative activity? So what has changed over the 3 years, the facts that have changed, is it has gone from being a micro issue of an investor to a macro issue of the economy itself. And therefore, we felt compelled that we must review our stance. As you know, we've been saying this for a long time. SEBI now eschews dogma and only follows data. Data and no dogma. So tomorrow, if the facts change again, we will change our views again.
So she said this on 19th of July. I'm just going to get a quick word from Vijay Chopra on whether this is a factor at all. Vijay, even with a lot of market participants coming and saying, don't throw out the baby with the bath water. Maybe make fixed deposits more compelling, etc. No need to strangle a fledgling market that's growing.
There are two parts to it, I guess. What SEBI is saying is also right. But who has started expiries every day? Has it happened without SEBI's approval? And, they are coming very heavily on finfluencers. But I see every now and then, I was traveling outside my city. Yesterday, I was seeing that there are so many people who are doing, literally tuitions in how to earn in stock markets and how to earn money in options. And if you go to Twitter or any social media, platform, you see tons of people still doing it. So who has started it? They started the fire. And now probably, even Shaktikanta Das came up and said that, the deposits are going down tremendously and the money is going into the markets and mutual funds. And Madhavi Buch said that, there's no capital formation happening and people are just losing money. So there are this coin has two sides and they have to look at, whether they can actually reduce the number of expiries. Was the earlier system of, Thursday expiry good enough? I think it was. So why to push people unnecessarily? Now the point is this new generation of investors, or I would say traders, who have entered, they have very, very less experience. They have not seen any major corrections.
Yeah. So I want to get Aditya's view on it. Do you think some tempering could come, is required?
Absolutely, Tamanna. I think, and I agree with Vijay, you can't blame the influencers or anybody else. Everyday expiry is not something that is going to help the market. Collectively on NSE and BSE, the overall volume of the FNO in the world is 81% is driven by NSE and BSE combined. So that tells you the kind of volume that is there in India as far as the FNO space is concerned. 81% of the global volume totally driven by NSE and BSE. So that is massive. And that is something that needs to be curbed because clearly that is a speculative trade that most of the traders are taking. And rightly so, because it's the young generation and they have the appetite to lose money and they keep on losing money. But they're not building any wealth. There's no wealth creation if you lose money on FNO. So definitely there has to be some curbs, and I am in for those curbs. Maybe bring back the old method of Thursday expiry and have higher risk if you have to increase the lot sizes, increase the VAR. You can do several parameters, several checks to deter people to enter into FNO speculative trading, especially.
Okay, so that's on the big topic, and let's see if tomorrow the budget has. Now, last 15 minutes of trade left. Some names, some PSUs which have gained. Aditya, just wanted your view if you trade any of these from the current levels. RCF, NBCC, or a Cochin Shipyard.
NBCC is something, Niraj, that I like, even though last week's stock did see a massive correction. But I think at current levels, again, it did take support at key areas, and from there it's bounced back. So NBCC is something that I like. I would initiate a trade here with a stop loss just below 180. maybe close to about 175, 176 odd levels for a target of 200 on the upside. And Cochin Shipyard, on the other hand, definitely is something which is interesting. But yes, the risk to reward is maybe 1:1. So on the upside, 2,900 is the target. On the downside, 2,400 is the stop loss. If somebody is okay with that 1:1 risk to reward, then Cochin Shipyard is something, yes, one can look at.
Vijay, do you track the hotel space? Indian hotels, chalet hotels, both of them are up and about. Are you an investor or a buyer at these valuations?
Well, the valuations are definitely steep, let me tell you. And I would definitely wait for a correction. I would just not jump and buy. Indian hotels are shot up today. But I think that, if at all somebody wants to buy, a 540, 550 level is a great level to get into this company. I respect the entire group and I track the entire group. They have done fantastically well in the last 5-6 years. And Indian hotels definitely is one of my top picks in the entire space. But definitely, there's one hotel chain called Hotel Leela Ventures, which I, track a lot, HLV. And I often go to Leela Hotels. Also, I have some membership there. So, I find that, they're doing some brisk business. And this is one stock which has not actually come up, and, the valuation mismatch is definitely there. ITC is also one of the major shareholders along with JM. So, this is one stock I would look at post-budget. I think there's a lot of valuation.
ITC, in fact, there's some very positive notes out on ITC today. So, I mean, not really because of their hotels business, but yes, the hospitality space is interesting. And this is something that, Puneet Chatwal said to us also in a conversation I had with him earlier today. Because Q1, believe it or not, I mean, the way that stock has moved would not tell you that, but Q1 has been a little slow because of heat waves, elections, and also because the Shadi season did not fall. Those dates have not fallen in this quarter, but July has already been quite a banger. Listening to what Puneet Chatwal, MD and CEO of IHCL, has said.
Elections, code of conduct, no government delegations coming into India, whether minister level or heads of states. The SIA dates, the auspicious dates moving into July. So, and you've heard all about the great weddings that have happened in the month of July already. So, all in all, I think we are on a good way forward. And more important in all this are the macroeconomic changes. Number one, demand remains strong and supply remains constrained, and demand is expected to outpace supply over the next 3 years at a minimum. Number two, we have a very good landscape in 125 plus locations in India, and India is experiencing good GDP growth, and good GDP growth is good for our sector. Number three is the investment that the government has incurred in the infrastructure in terms of new airports, in terms of renaissance of train stations, and the 6-lane highways, the way they are coming. This should encourage more and more travel. So all in all, with all these factors, I think the sector is well positioned and a lot of activity is happening. If we look at it post-COVID, the sector has experienced not just from a room nights and a demand point of view, but the activity in the sector, the private capex that is going into the sector in building new properties is one of the highest. Actually, till last year, it was the highest private capex was in the hotel sector.
Okay, so it's been a good year, and remember, IHCL still has a guidance for double-digit revenue growth, even though Q1 has been soft. Q2 is usually, traditionally softer than Q1, but they think it'll be different. And the big bet, of course, on foreign tourists returning in October. Anyway, we are just a few minutes away from closing bell. But what are the expectations for budget tomorrow? We spoke earlier in the day with Gautam Duggar of Motilal Oswal and Nirmal Bank's Rahul Arora, who laid down their views on budget 2024 and the impact possibly on markets.
I think we overhyped this event too much. If you see the last 7-8 years, you would notice that budget gets discussed 24 or max 48 hours. After that, market forgets the budget and goes back to fundamentals. I don't think why this time it should be any different. Yes, there are some expectations because this is the first budget of the Modi 3.0 government, and clearly the setback that they've received in the elections. So there are some tinkerings that can happen in the overall budget numbers. But broadly, I think the policy of fiscal conservatism and overarching focus on capex should continue with a little bit of tilt or some allocation given to bottom of the pyramid or middle class or tax giveaways, so have you, because you have 1.5 lakh crore of extra firepower available thanks to the RBI dividend. So I hope the government utilizes it sensibly and encourages consumption at the bottom, because that is one area which has been severely lagging in the last 2.5 years if you look at the corporate results.
I still think in the BFSI sector as a whole, valuations are not demanding. I mean, the elephant in the room, HDFC Bank, currently trades at about 2.2 times 1 year forward price to book. They've grown their NIS by 26%, their profits by 35%. I mean, I don't know what else the street wants from this company, but I think, names like this, I think you have value picks even in the insurance sector. I think there is some value even on the gold finance side. Something like a Manappuram Finance, where for a 16-18% return on equity trading at 1 times price to book. So I think definitely BFSI is one place where you could look at.
All right. So these are some of the spaces that you could look at in this budget. Let me talk about BFSI for just a second. And Aditya, let me come to you. HDFC Bank, I think, was the positive surprise of the day. But apart from that, anything that you are tracking right now and keeping on your list in the BFSI space?
Bajaj Finserv, Tamanna, I think this is one stock which has been neglected big time, and I think so it's time to look at that stock. Again, this is more from a positional point of view. If somebody wants to buy the stock at current levels, somebody can do that. And I'm looking at a target of 1900 plus on the stock. So between 1900 and 2000 is what I'm eyeing for the stock. On the downside, 1500 is a very strong support area for the stock. So I think it's a matter of time before it breaks out and tests those levels of 1900, 2000. One can definitely start nibbling into Bajaj Finserv from the BFSI space, definitely.
Okay, so Bajaj Finserv is one of them. Vijay, do you have any favorites in this space? You're on mute, Vijay.
Yeah, I think that I would wait for tomorrow's action, and then would take would give some recommendation. I like a lot of banks, although mid-cap bank, PSU banks, but I would love to wait for a day or so and then probably recommend.
But Vijay, while you will wait, what is on the list though?
Well, I think there are good banks like Indian Bank, Bank of India, Bank Baroda, Can Bank. I like these companies. The Canfin Home has corrected a bit, but I think that, these home finance companies look very good. Companies like Poonawalla Fintech, Poonawalla Finance, they look very good. So a lot of companies are there, but, I'm just wary of if there is some kind of a negative news flow, these companies might react negatively. So I would just wait for a day or so. And then take an informed decision. So I've mentioned quite a number of companies where I'm looking at.
Okay, so those are some of the ideas in the financials space. Is IT a no-go area right now, Vijay? I mean, apart from tomorrow, I know tomorrow you're taking a break from all this, but
well, I think that I was recommending IT almost 6 months back. And I also recommended, because, if you're a trader, you should book profits. So we actually, we manage portfolios. So we actually book profits in TCS, in Infosys and other companies. Infosys actually ran up quite a bit. But I think that, post some correction, I would definitely love to get into IT with a, short to medium term perspective. But right now, I won't say that you jump and buy.
Okay, so don't jump and buy right now. All right, let's just take a look at what's really moving as we get into close, and just pull up the heat map as far as the Nifty is concerned. We'll get to the top gainers and losers in the broader markets as well. So completely flat on the markets is what I would say. The Bank Nifty marginally in the green right now, and that too would be thanks to HDFC Bank in a large part. In terms of the losers, Wipro leads the pack undoubtedly across the board. Tejas Networks also doing quite badly, and despite the numbers looking fairly decent, down 6.5%. Phoenix Mills is hurting, as is quite a few realty companies. Raymond continues to have a very tumultuous time. On the winning side, it it continues to be all about, I would say, fertilizer stocks, even some affordable housing plays. Look at an NBCC today. I want to see what Awas and Hutco are doing. And these will be key themes ahead of the budget. NBCC up about 8% nearly. Hutco also up in the green. We'll see what Awas Finance is doing. So these are some of the plays you need to look at. Indian Hotels, we talked about. Awas Finance also up about 3%. Indian Hotels, Chalet are some on the tourism or say hospitality side, which are doing fairly okay. But as far as realty space is concerned, apart from an Oberoi Realty, everything else hurting quite a bit. Hudson Agro, which was flying because of their numbers, has seen some profit booking coming in, and banks apart from an HDFC are not doing too well either. So I would say it's a very careful wait and watch day. I think a lot of people have the same idea Vijay has, to sit on the sidelines for some time. But Aditya, once you have the budget sort of out of the way and some clear picture, if there's going to be a huge departure, huge increments, what would be the sort of strategy that you would come back with, say on a Wednesday?
I would stick to large caps predominantly, because I still believe this is one space where there is under ownership and a lot of room for outperformance, because the mid cap over Nifty and small cap over Nifty, the ratios are trading at all-time highs. So that clearly shows that there's a massive underperformance from the large cap stocks. You name it, be it Reliance, be it TCS, be it HDFC Bank, Infosys, all of them underperformed. So I think it's time to look at these names. Reliance, why not? It's down 3%. Very close to its support area of 3,029.50. I would be a buyer in Reliance. If you were looking to buy Reliance, today is the best opportunity to go long on Reliance. HDFC Bank corrected from the top, I think, so it's again a very good opportunity to buy them. And IT stocks, again, I think IT will continue to outperform. If anything, we did analysis on the sectoral performances post-elections, and IT is the biggest gainer 6 months post-elections. They gained 36% on an average, and we did this for the last 4 elections. So overall, I think I will stick to large cap names, and these are some of the names which I think should be looked at if you're looking to build your portfolio. Reliance, HDFC, TCS, Infosys, HCL Tech, all these stocks I think should be looked at, and maybe an Asian Paint something. Not immediately, but once the consolidation is over, I would look at Asian Paints as well.
Okay, interesting. Aditya, Vijay, gentlemen, thanks so much for taking the time out and being with us. Really appreciate your time this afternoon. Let's start wrapping up the markets. And it's for the PSUs, it's a happy hunting ground. Otherwise, it's a flat market. A flat market belies, though, what's happening underneath, because a lot of heavyweights have cracked quite significantly. We should pull up the India VIX for a moment before we get to individual stocks very quickly. The India VIX, not a dramatic uptick. In the morning was a bit higher, but doing okay. Get the heat map up on the screen, and you will see a Wipro, Reliance, Kotak Bank down at the bottom of the pile, and then an ITC following suit along with an SBI. But HDFC Bank with 2% gains is thwarting some of that pain, and along with an NTPC, a Grasim, Ultratech, and a few others, has done well. Must say that I think it's HDFC Bank's uptick that is helping the market still stay this way, because otherwise on a day when Reliance falls 3.5%, it's very difficult for the markets to see that bit of an uptick. And before Tamanna comes here, just this is the important piece. HDFC Bank, like I said, 60 points, trying to thwart some of the downtaken pressure that Reliance Industries has put on the indices today. Kotak, ITC and Wipro are the other ones, Tamanna. But good names, good move from Infi too in the session today. That 1% uptick, but heavyweight and therefore a little bit of green contribution.
Yeah, so I would say if you look at it from the perspective of how the market started, it's not half bad, Niraj. And that too, you have some comeback kings and queens here, which would be in the form of your fertilizers, your affordable housing plays. So a bit of that needs to be put into context as well. Look at how the mid cap and small caps are closing a day before, just before the budget session, and that's a big day. Mid caps have seen a decent recovery. And there you have it, still up about 1.5%, 700 points up on the Nifty mid cap, the Nifty small cap also about a percentage up. So you have seen a decent recovery here. I'm just going to pull up the gainers and losers on the BSE 500 before we wrap for the day. And remember, a whole lot of programming coming up on NDTV Profit. Wipro is the top loser. No prizes for guessing why. I don't know if they deserve to be beaten down so much, but yeah, Wipro is hurting. So is Tejas Networks. That's again results. Phoenix Mills sulking with a lot of other real estate companies as well. So those are some of them. This has been one of the big culprits about why you're seeing your top, your key index, your Nifty with a bit of pressure. But look at this side. I think this is interesting and telling me that there's a bit of IT budget play back on hand. RCF nearly 10% up, and NBCC up there. Fact has also done fairly well today, and Indian Hotels and Chalet. Maybe we could see some big boost for tourism, because remember, if you want to focus on jobs, that's one sector.
Yeah, also the commentary about July being so strong from Indian Hotels also helping.
But Chalet also jumping up.
So, I mean, what would be good for Indian Hotels, possibly for the space at large? And very interesting, because Tamanna pointed out RCF, Deepak Fert and some of the others too have done well. So fertilizers certainly doing well. But like Tamanna said, a lot of programming on the other side. But for now, thanks for tuning into this show from Tamanna and me and the team that put this show together. Thanks so much for watching.